All right, now good afternoon, everyone. Thank you for joining us. My name is Jeff Foley with Paladin Financial, and thanks for tuning in for this quarter, our webinar update. And today we're going to talk about quick market update. There's a lot going on in the news, and just give you a quick update on where things are at today. And also the focus point for today's webinar is to talk about annuities, which is a product that a lot of people have misconceptions about. Sometimes they're misused in certain environments. So we want to educate you a little bit about what your options are with annuities. May or may not make sense for you, and make sure that you understand how those work and what your options are. So it's good to be educated about that. Before we dive into today's content, our schedule for this year for our different events. So today we have our quarterly webinar, and you can see the dates on the screen for the rest of the webinars that we have set up for the remainder of the year. So save the date on those. We also have an educational event coming up, which is in our office building on the first floor. For those that haven't been back to our office since last April. So April, there was a flood on the first floor, and the first floor was completely gutted and rebuilt. Looks beautiful, but that will be back in our conference facility on the first floor on March 10th. And that topic for that event will be taxes. So we're going to walk through an income tax return and talk about how different things are taxed. What does that look like pre and post retirement? And who does not like to get together and talk about taxes? So we thought that would be fun. Some fun events coming up, more fun events, I guess you'd say. We have our most awaited ice cream social on June 9th, and the pie pickup later on in the year as well. So again, save the dates if those are something you're interested in attending. And if you're not following us on any of this social media, please do that for us. We would truly appreciate it. It helps us to get our name out there and help more people in the community, your friends, your family, coworkers, etc. Also check out our podcast. And as I like to say, after you've listened to it, give us an honest 5-star review. We'd appreciate that. But please keep in touch. Also, a couple of new offerings that we now help support our clients with. If you haven't gotten the memo, if you are age 65 in particular, and you need help with Medicare and navigating all the mailings that you get and the options for Medicare supplements, Medicare Advantage plans, all of that, we now support our clients in navigating that. So we're an independent firm. We have all the major insurance carriers, can help you with those items. Also individual and family health insurance. So prior to age 65, if you need coverage, Nikki Foley, my much better half, is the person to contact, and there's a QR code up here if you want to get something scheduled to chat with her about that, and give us a call, email, etc. So we can help support you through that. We also launched in the last year Paladin Legal Services. So for our clients that do not yet have an estate plan in place, wills, trusts, financial power of attorney, healthcare directives, all that fun stuff. We launched Paladin Legal Services because although we have some great relationships with estate planning attorneys, many of you that I see that are on the webinar today have used them. But for those of you that don't have that in place, common bottlenecks we saw were cost, getting a 20-page questionnaire from an attorney and not wanting to spend the time to fill that out, and it's just one more thing. So with Paladin Legal Services, we can get that done for you, and usually significantly lower costs than working directly with an attorney. We are not attorneys. We have a platform that we subscribe to called Estate Guru, which is built and powered by attorneys. And if you have questions about that, give us a call. We can dive into more details, but wanted to make you aware of that if you need an estate plan, or if you have a friend or family member that you want to help them to get that done as well, give us a call. All right, so jumping into the market updates, you're going to see a number of slides here. I'm going to go through these fairly quickly. I want you to just kind of get a feel for where things are at in the market so far. What you see here is major asset classes across the board in 2024. Things were up. We had a very good year last year. 2025, this is through the end of January, all major asset classes are positive at that point, and we've seen a lot of volatility. I think we're going to see more volatility throughout the year, but the fundamentals of our economy overall look pretty darn good, as we'll talk about. Yes, there are going to be some bumps in the road, and we've seen some of that here in the past week that we'll talk briefly about, but so far so good out of the gates as you look at different asset class returns. GDP, which is our gross domestic product, is a measure of our nation's production. and you see over time, what does that production look like? That 10-year average line, that purple dot running left to right, is the 10-year average, and you see where we're at currently. So right on track with that 10-year average. We don't want too much growth, and we don't want to see things go backwards. So healthy from that perspective. What about jobs? So the unemployment rate, you'll notice the color coding on here. Some of these are green, yellow, red. Unemployment is looking pretty good, 4.1%. You have unemployment claims as well, that those are looking good as well. There's some debate there. Are there people that are not claiming, that have just kind of given up on things? But the unemployment claims as a statistic is looking good. Job openings, it's bounced a little bit back and forth here, but generally trending okay. Next, inflation, probably the biggest one that's on most people's mind. Core inflation has come down. You see over the last couple of years, still hovering in the 3 range, but the biggest thing is that has dropped off quite a bit in a more reasonable pattern. We want to see that a little bit lower. Food price, probably the biggest one, has impacted people as well. That too has dropped quite a bit, and we're not seeing negative food prices. So our eggs are not what they were in the past. Even if the inflation dies down, that still means the cost of eggs is going up. They're not going backwards. Gas prices, though, are coming down, so that's a positive. Definitely have felt that at the pump. Another big one that's been on the news and on everybody's minds here over the past week is tariffs. So if you think about the tariffs that the Trump administration has put out there and all the goings on with that, we're not done with that. We've got a 30-day stay on a lot of this. But our 3 biggest trade partners, Mexico, China, and Canada, by a long shot, those are the 3 companies that have been targeted as part of that tariff program. We'll see where that shakes out. Initially, when that was going to go in effect here a few days ago, the market declined, and then it's popped back up. And if you look at 5-day returns, it's, I think, down about 0.25% on the U.S. stock market over the last 5 days. So it hasn't had a big impact thus far. We'll see where that ends up in 30 days. So a lot more will unfold as the countries go back and forth on what will happen there. Which is a good reminder. I mentioned a little bit ago that we do expect a lot of volatility this year. If you look at annual returns in the S&P 500 going back a long period of time, the maroon bar shows us the ending S&P 500 performance for a particular year. So if you look at, for example, 2024, any year that you pick along the way, I'm going to use 09. So 08, 09, up 23% at the end of the year, but intra-year returns, the market was down 28%. This year, S&P ended up 13% positive for the year, but during the year, we had a 10% decline. So any year where you see positive growth, we still see some negatives throughout the year. So we want to keep that in mind. That's an indication of volatility. There's always something going on that's going to influence the market, but by and large, as we'll look at here in a moment, the market goes up over time. What this shows us, that vertical line in the middle, again, looking at the S&P 500's performance over going back to the 1920s, to the left of that line are negative years, and you can see which years were negative and to what degree. So 1931 was down over 40%. Many years that were down 0 to 10% here in this highest column. And then to the right in the green are positive years based on different 10% categories. So 3 out of 4 times roughly the market is up. Now, I'm not a gambling person myself, but if you go to the casino and you could find a game where you win 3 out of 4 times, people would be lining up left and right for that. You're not going to see that in the casino unless you're counting cards somehow. That's a pretty good bet long term, but we've got to sustain and live through the red years on the left. How we do that? Have a sensible plan, not get too greedy, have different buckets that we talk to all of you about in our financial planning process. Make sure you have money that's safer, moderate, and more aggressive, but sticking with that long term is going to pan out. We've gotten maybe 1 or 2 calls over the past week with the tariffs and what's this mean and what do we do about this? We can't control the things on the right, the market, elections, who tweets what, etc. tax law changes other than through our votes. On the left, those are the things that we can control. So if you're allocated properly, you haven't had a big life change, we want to let the market do what the market does over time and not try to time it. It does not work out very well. So sticking with that is extremely important. I think this is one of the most important lessons for us as investors and for us and what we do in helping our clients is to focus on what we can control. So that being said, that's a quick update on the market. We're going to switch gears to talk about annuities and the different types of annuities that are out there. Again, we offer annuities to our clients where appropriate. We have some clients that love annuities and they want to put too much money into annuities. We have clients that don't want anything to do with annuities. That's fine as well. We can make your plan work with and without those tools, but we do look at those as tools and making sure that we're using them in the right situation and we know what the trade-offs are. Now, if you do have questions about annuities that you want to type into the chat, feel free to do that. And if there is time, depending on how much I ramble, we'll come back to and try to answer some of those questions. But we'll dig in. So with annuities, I think a good analogy to think about these, I talked about tools. Another way to look at this is a vehicle. So annuities are like vehicles for retirement. You have various types of vehicles. You could buy cars, trucks, SUVs, buses, you name it. Everything has trade-offs. So understanding what's the right vehicle for me in planning for retirement. So we're going to look at if you're buying a car, fuel efficiency, cargo space, and so on. With annuities, what is my risk tolerance? What are my liquidity needs? What are my goals overall? Am I retired? Am I not retired? Those are all things that we navigate for our clients. So also, the other thing that comes up with annuities is they have been around for a very long time. Literally, they go back to Roman times, the original annuities. At different points in history, governments issued annuities. Nowadays, those are issued through insurance companies. Just like the vehicles that we drive around with, annuities have evolved quite a bit as well. So a lot of things, when people think about annuities, they're thinking about annuities in the past. They've changed quite a bit. Digging into different categories of annuities, high level, I want you to think about immediate annuities and deferred annuities. So immediate annuities is a common one that people immediately think of when they hear the word annuity, because this is the original form of annuity. You give your money to an insurance company, and in return for that, you lose your principal, but you have a guaranteed income stream that can last as long as you do, you and your spouse, or a given period of time. So there are different ways of using that. Now, we haven't used an immediate annuity in our firm in years. They are a tool. They make sense in certain situations. For most people navigating retirement, it's not one that we commonly lean to, but those are an option that we can help people with. So you lose your liquidity. So for example, if you pass over $100,000 to an insurance company, you're going to get a guaranteed lifetime income stream typically, and you lose access to that principal. Benefits of that, you know what your income is going to be. It's guaranteed. You're not impacted by the market. And if you're getting money in your bank account every month from that annuity, it does help to kind of force some budget discipline. So that's one way people do use it is, hey, I don't trust myself. I know I need $3,000 a month. How much money do I need to put into an annuity to generate that $3,000 and make sure I don't spend my money too quickly over time? They can provide better returns than bonds and CDs because it is a long-term agreement. And I'll use CDs as an example a couple different times, but if you walk into the bank and you want a 90-day CD, they're not going to give you much of an interest rate, whereas if you commit to a 5-year CD, they have use of your money for a longer period of time. They can afford to provide you a higher interest rate. Same logic applies with annuities. Is the insurance company receives their money up front, they're going to invest it and do what they do over a long period of time. Therefore, they can afford to provide you a higher guarantee. Many immediate annuities do not offer inflation protection. So whatever your initial payout is, that was going to stay flat for forever and ever, and as long as you live. And that's something to be aware of. If you're using IRA money to fund an annuity, one of the considerations is once you move that into that IRA and you start taking that income stream, you cannot convert that IRA into a Roth. And for a lot of you listening here today, we're very pro Roth conversions in the right situation, you would lose that flexibility. Similarly, when we help clients, if you have a pension and you're evaluating, should I take the lump sum amount and roll that into an IRA, or should I take that pension amount? One of the considerations there is if you take the pension, you lose the flexibility of converting that IRA money into Roth. So if you have IRA money, put that into an annuity, all that money is going to be taxable for the rest of your life. So those are immediate annuities. So I skipped over my bus here. So the analogy here in thinking about an immediate annuity is if you're going to take a bus ride from Minneapolis to Chicago, you know what the route is. It's going to get there on time. They've got it down to a science. It's like clockwork. You pay your money up front. You're going to get to your destination. So that's your immediate annuity. The RV, if we switch over to deferred annuities, it's the opposite of immediate. With an RV, you can take that to wherever you want to go, park that for a prolonged period of time, and you decide when you want to move, when you want to take money out of that annuity. So with deferred annuities, we have different subtypes that you see at the top. You have traditional fixed annuities, fixed indexed, variable annuities, and these things called RILAs that we'll talk about here in a moment. Within deferred annuities, the idea is you put your money in, and somewhere down the road, you start to take money out, and there are different ways that you can pull that out. You could take out, for example, 10% of your account value each year. You could set it up on autopilot and receive income every month or every year, but this provides you the flexibility to stop and start that income and adjust it, whereas with an immediate annuity, you cannot change that. Can provide potential for higher growth, again, because of the long-term nature of the vehicle. So many ways that you can customize those, and they have what are called surrender charge periods. So that might be anywhere from 1 year to 10 years is typical. Most commonly, if we're using those, we're looking at a 5, 7, or 10-year type of term. So similar to a bank CD, if you walk into the bank and get a 5-year CD, you're going to have to you're with that for 5 years, and you're not going to have full access to that money during the 5 years. So at the end of the 5 years, it's fully liquid, and you have liquidity options within the 5 years that you can tap into that. Some products have fees, some do not. If it does have a fee, usually that's accompanied with some additional benefits, for example, guaranteed lifetime income, and that's something that's going to vary by product. And then also tax deferred growth. So why is that important? Well, if you look at after-tax money, for example, that is sitting in your bank, so you have excess money that's built up in your checking and savings, and you're earning point whatever on that money, you're getting taxed on that along the way. If you take some of that money and put that into an annuity, that money now grows tax deferred. So for example, if you're getting a 4% rate on a fixed annuity, or let's say 5%, you could do that on a 5-year right now, 5% guaranteed for 5 years. Let's say you're in a 12% tax bracket, you'd have to have a 5.68% interest rate on a CD to equate to that 5% fixed annuity rate, because the fixed annuity is going to grow tax deferred, and you don't pay taxes until you pull the money out of it, whereas the CD paying 5.68, for example, you're paying taxes on it each year, even if you didn't take the money out. So if you're comparing annuities and CDs, this is a tool that we look at to compare, all right, how does the annuity rate match up with the CD if we're talking about after-tax money, and have a proper comparison there. So tax deferral, that can add quite a bit to your growth over time. So again, with deferred annuities, we have different subtypes. Continuing our vehicle analogy here, traditional fixed annuities, think of that kind of like a sedan. So a sedan, you get decent gas mileage, relatively safe, predictable. You're not going to do anything crazy with it. It's going to get you to from point A to point B pretty safely. That would be an example of a 5-year rate guarantee. So I want to get 5% or 5.1% guaranteed for 5 years. And at the end of that money is fully liquid, and I decide what I want to do with it from there. That would be an example of a traditional fixed annuity. So with interest rates having risen over the last few years, and we're kind of at our peak, we're starting to see those to come down. Those fixed annuity rates will start to come down as well. Now is a great time to lock in those rate guarantees. You also have what are called fixed index annuities, or sometimes they're abbreviated as FIAs. So similar to a fixed annuity, they're principal protected, so you don't have any losses based on the market or interest rate fluctuations. They have a guaranteed minimum return by the end of that period of time. And in between, each year, the insurance company looks at how the market has performed. And a common example of this is the S&P 500 index. So you can link your annuity to different indexes within that policy. And you're not getting 100% of the return of the market. You have some limits on that, but you also don't have any losses. So if the market is down in a given year, your money is not going backwards. If the money's up, you get growth up to whatever those limits are. So for example, I won't walk through all these, but one of the examples there is a cap. So for example, you could get the S&P 500's growth up to a cap of 9% in a given year. So you get your growth is going to be 0 to 9% in that year. One of the neat features of these is if at the end of a policy year, the market is down, you reset at that lower ending point for your next year's return. And I'm going to contrast this to buying a stock. If you buy a stock at $100 a share, it drops down to 70, you're not going to make money until that stock price gets past 100. That's what you paid for it. With the annuity, the fixed index annuity, if you're linked to the S&P 500 and the S&P is down 10% in a given year, you have a 0 as your growth for that year, and your starting point for year 2 is that lower S&P 500 index value. So you can make money even if you're below what you started at, which is nice. So the car that you see on here, that's a hybrid annuity, meaning it has some features of the traditional fixed annuities, and then you have the market indexed growth. So again, what might make sense for you in your situation, what you're trying to accomplish. An example of the fixed index annuity over a period of time is what you see on the screen here. So going back to the year 2000, this blue line represents the 1-year treasury rate throughout the years, so it doesn't move too much. The red line shows us what the S&P 500 has done each year throughout that 24 years. And then the fixed index annuity, as an example, one of the things that you see is you don't have any losses. So in years right here where the market is down, the annuity stays level from that year, and the market rebounds in the following year, you have some growth. So you're always going to see that ratchet up, stay level, but it's never going to go backwards. So that's a kind of a visual example of how the fixed index annuity works. Again, may or may not be the right fit for you. The next type of deferred annuity we have, another common one when people think about annuities, they think of variable annuities. They've also been around for a very long time. When you put money into a variable annuity, you have the ability to invest in different mutual fund like what are called sub-accounts. So one company I can think of, they have 99 different options on how you can invest the money. You can be in small cap, mid cap, US, international, you name it. It's very robust in terms of the investment options. You can have high returns with those, but you do have market risk, so it can swing depending on how aggressive and how conservative you have that invested. So it is customizable. If you want to be more conservative, you're going to lean more into bonds, more aggressive, more into stocks, and everywhere in between. And the big one with variable annuities is the fees. So depending on the type of product that is used and the bells and whistles that are attached to that, those fees could be fairly low, around the 1% neighborhood, or they could approach 4%. I've seen people that come in, they have 4% fees between all the bells and whistles that are on their policy that they bought years ago. It may or may not be a bad thing. That's going to draw down the account value, but if they're getting a significant benefit either through an income rider that provides guaranteed income for life or a death benefit, those may or may not make sense. So the sports car analogy here is they can have high growth. You got to be mindful of that, and may or not, again, be appropriate for you. But variable annuities get a lot of negative attention, I think, inappropriately. It's a tool, use it appropriately, and it's just fine. The last one we'll talk about is what's called the RILA, and these have really grown over the last 5 years in the annuity industry, registered index-linked annuity. So if you remember back the fixed index annuity, the concept was you don't have any downside, but you're limited on the upside. The RILA is a type of variable annuity where you can have higher growth potential, but it does have some loss that could occur. So they have what are called buffers or floors on the downside. So for example, that buffer might mean if the market's down at the end of a year, it eats the first 10% of losses, and you would pick up losses beyond that. Or a floor is, hey, I'm comfortable having up to a 10% loss in a year, but if it drops down below that, I don't want anything to do with that. You can structure those different ways. So those have become extremely popular because the market continues to go up since COVID arrived at our doorstep, but we have volatility along the way. This gives you some protection elements. And I put on here, what is the cost? Most of these products do not have stated fees. Your cost, in essence, is built into the caps and the buffers that apply to that, but typically you're not going to see a 1% or 1.5% fee that is coming out of those each year. So again, different types, different options within deferred annuities. Now, the other thing you want to look at is how are annuities taxed. So with think of an annuity or think of an account as a bucket. If you have a non-qualified account, within that bucket, you're putting in after-tax money. So for example, you're pulling money out of your bank account. The money that you put into an annuity would grow tax deferred. And as we talked about earlier, when you pull that money out, you're going to pay taxes on the growth on an ordinary income basis. If you have IRA money, that money continues to grow tax deferred, comes out as ordinary income. So no capital gains are going to apply to annuities. With Roth funds, the money grows tax deferred, and as long as you play by the Roth rules, that money comes out income tax free. So depending on the source of the money that you're using to fund an annuity, the taxation of that is going to be driven by the status of that money that you put into it. So depending on your situation, like Roth funds, usually on a fixed annuity, if we're using those, we're typically not using Roth funds because we generally want to be more aggressive with Roth funds, but that might be appropriate for a variable annuity or a RILA that we talked about. So taxation is important. So some things to consider with annuities and understanding, are they something I should explore? One of the things is liquidity. So the money that you put in, most annuities, it's not fully liquid. Most commonly, you can access 10% of your account value each year after the first year without penalty. If you take out more than that, then you would pay a penalty. Similar to a CD, with most CDs, you can pull out the interest each year without a penalty. If you pull more money out than that, then you pay an interest rate penalty. What's your risk reward trade-off? So if you're more conservative or more aggressive, if you're considering an annuity, looking at the right type, and you also want to understand how that fits into your overall financial plan. Are income needs and guarantees important to you? Some annuity products, you can get lifetime guaranteed income for your life, your spouse's life, without losing control of the principal of your money. So those are some high-level things to consider. Where they might be a fit for you if you're wanting tax-deferred growth. So for example, if you have some after-tax money that you don't need, you could put that into an annuity. It grows tax-deferred. You might want some money protected from the market. You're okay with not getting 100% of the market. So for example, the RILAs or the fixed annuities, the fixed index annuities, you're not going to get market growth with that. If you're okay on a portion of your money not getting the full market, that would be a consideration. And as we talked about, if you're wanting that predictable, guaranteed lifetime income stream, depending on the type of annuity used, that is a feature that you can plug in. Misconception here is people think of annuities, they immediately think of income. You might not need income, and an annuity might still make sense for you. So a lot of the annuities we're using are for safe accumulation, and you're not taking money out on a regular basis. We have others that have lifetime guaranteed income that is coming out of their income, depends on your situation. And then estate planning or death benefits. There are products out there that provide different features that are very beneficial for beneficiaries from a death benefit perspective. So those are some things to think of. They may not be a fit for you if liquidity is concerned. So if you are spending a lot of your assets each year and there's a risk of you running out of money, you might not have enough liquid assets. Generally, an annuity is not going to be a good fit for you. On the other end of the spectrum, if you have plenty of liquid money, might make sense. You have a high tolerance for risk. So if you're not looking for any type of protection whatsoever, then a lot of the annuity types we discussed wouldn't make sense for you. Even if you have a high tolerance for risk, something like the RILA, the registered index linked annuity, could be a fit for a portion of your money because you can get some decent growth and protection there. If guarantees, again, are not important for you, and if you're not looking for income on an ongoing basis. So there's a lot that we work through in working with our clients to see, is this the right fit for a particular situation and a client. Again, we can use them or not use them based on what goals we're trying to achieve with your financial plan and what your interests are. So if you have any questions about annuities, or if you have one we haven't seen before, we can take a look at that, help you to understand how that works, and make sure that you're maximizing your opportunities with that product. So that's a lot about annuities here. Wrapping things up, some next steps. If you have any questions about annuities, give us a call. We can dive into that. Schedule that Medicare related appointment. So if you're approaching 65, you're over 65, and you would like us to support you for Medicare related services, give us a call and we can do that. So Advantage plans, supplements, and so forth. And you could schedule time with Nikki Foley to talk about that. Third, contact your advisor to learn more about Paladin Legal Services. As we talked about earlier, if you don't have an estate plan in place currently, you want some help with that, we can walk you through what we offer at Paladin Legal Services, see if that's a fit for what you're trying to accomplish. Call us, text us, send us an email there, and we'd be glad to help you out. Wrapping up, again, this is what we do for our clients, everything that you see on the screen here, and in our comprehensive planning process. If you know someone in your life that needs help with these things, retirement planning, investments, whatever it might be, we would truly appreciate the opportunity to serve them. So please keep us in mind as you talk with those in your life. And thank you all very much for attending our webinar. I'm not seeing any questions come in here on annuities, so we must have covered everything for you. Make it a great day. Stay warm out there for those of you that are here with us in the Minneapolis area. We appreciate the opportunity to serve you, and have a great rest of your day. Thank you.